But let's shift focus to something that's not looking all that mighty high and the state of the economy. We have with us Indranil Sengupta, economist and head of research at CLSA India, joining in on the show right now. Indranil, hi, morning. Great to have you on ET now as always. The IMF is expecting recession, rate hikes speedy, a lot of pain ahead. What is your own vision on where this is all going to lead us?
Well, I think that, the next 2 years are obviously going to be rough. And we also think that there will be a combined recession in the US as well as Europe. Uh, India is relatively a safe haven, given that the RBI has high FX reserves. But we'll also obviously get affected to some extent. We are looking at growth, for example, slowing to 6.8% this year and 5.5% next year. But having the cushion of domestic demand and high FX reserves, we will be relatively less affected.
Indranil, where do you think the Fed is going to stop hiking rates consequentially? And I'll tell you why I ask this, because after the recent employment data, part of the market was actually praying that it should be bad so that the Fed is not going to go on hiking.
So we are looking at the Fed stopping at 4.75 by February as of now. And reading from there, we think the RBI probably stops at 6.5%.
Indranil, at what point in time the Reserve Bank of India would be tempted not to protect the currency? We've lost about $120, $130 billion in our defense against rupee and in our defense against dollar, not rupee. And it's been a futile exercise because dollar is not at dollar index is not at an all-time low, but rupee is.
Yeah, so, let me answer that at three levels. Number one, a lot of the decline in FX reserves is because of revaluation factors, which will, turn around when the dollar, I presume, goes back to 110 a euro, 115 a euro over the next 1.5 years. So that's number one. Number two, I think the RBI has been gradually letting the rupee go for now, because, like you said, that how much of precious FX reserves can you spend? But at the same time, I think the rupee will claw back to 79 levels by March if the dollar goes to about 1.03 a euro that we do expect. Finally, I will say that, with commodity prices rising again, letting the rupee go is no longer an option because, then you'll only invite inflation. So you have to hike rates to keep about 200 basis points differential with the Fed, number one. And number two, you have to look for a way to shore up FX reserves. One could be to do some version of NRI bonds. For example, you could issue infra bonds to non-resident Indians and raise about $25 billion.
But Indranil, this whole view which everybody has that India is a standout beneficiary of what is happening in the world on the manufacturing front, on the economy front, why is that not getting translated into currency? Stock markets have been resilient, but if one looks at the currency has not been as resilient as stock market.
The currency on a relative basis has been resilient. As you can see, the depreciation has been vis-a-vis the dollar, vis-a-vis the euro, vis-a-vis the yen. We have actually appreciated. So if you look at the basket of currencies, there's hardly been any depreciation.
I mean, you can always look at the relative basis, but we're spoiled to look at absolute because we always look at stock markets. Indranil, my next question is at what point in time the hike in interest rates will start hurting demand? Let's look at a real experience. The home loan rates, let's say 2 years ago, they were 6.5. Now they're nearing almost 8%. At some point in time, high inflation and the affordability vector will start getting challenged. You may want to suddenly downgrade from a premium car to a car with extra features, or you may want to give away those extra features because the car cost is higher. All that directly, indirectly will start having impact on demand per se. How far are we away from that?
So I think that's already begun to happen, and which is why we are looking at growth slowing down to 5.5% next year. And also recall that 6.8% this year with a very high base in the first quarter means that we are seeing sequentially the economy slowing down already.
Thing is, Indranil, and since you're not just an observer of the economy, but economy at large, for the market watchers, the other concern and the sort of linkage between what's happening with our Western economies and us is a large concern for investors when it comes to the IT sector is also, in this recessionary scenario, is IT growth going to be meaningfully impacted? Or will the secularity of going digital continue? As an economy watcher, what is your own sense?
So I think that we are not seeing, as of now, a very major indication of slowdowns. But yeah, if the US and Europe go into a combined slowdown, you will see, people delaying closures. That
Job
is typically
creation,
what happens most of
the
the time.
large part of your job creation, at least the numbers what we have, has come from the IT sector. Fresh jobs, startup jobs, gig economy jobs. If that sector per se slows down because of global recession, because of what's happening to the Western world, could that have an impact on indirect demand? We all were surprised with how demand got unleashed post COVID. We all were surprised. But large part of that was also because of gig economy, IT jobs, IT services started hiring, wage hikes were high. If that wheel comes to a grinding halt, what would be the implications of that?
So I think demand is weak, and if you look at the RBI's consumer confidence index, I think it's still below pre-COVID levels. As the world slows, demand will slow in every country, including India. But because you have a cushion of domestic demand, it will probably slow lesser. In so far as the IT part is concerned, maybe there's also a bit of cushion in more outsourcing when you face troubled times in your home country. So that's a bit of a cushion. But in general, look, when if we really see a combined US and European recession, every economy in the world is going to get affected.
Indranil, great to have you on the show today. Thank you so much for taking the time out and joining in.
Thank you.